This process has been unfolding by stealth. We've looked at it on the charts month by month by month. Now the train has left the station.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. You know, Live from the Vault is a show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We bring you exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi there, my name is Shane Moran, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. And get ready for another packed episode of Live from the Vault. We'll bring you the knowledge and we'll bring you the understanding that the mainstream media just will not provide. So just before we head over to the UK, please help keep spreading the word about this channel by hitting that like button there if you haven't already done so. Share this information so more people can find out about precious metals. And if you subscribe and hit that little bell there, we will notify you as each episode goes live so you don't miss a thing. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, here we are again, just 2 weeks after our last market update episode. And there's so much, it seems, to catch up on. And looking at the subscriber questions, you know, we're breaking it down here, but they're asking about what to expect as we cross over into the massive U.S. elections here. I think historical U.S. elections and how that leads us into the end of the fourth quarter. And lots of questions, by the way, Andrew, related to your own personal take on what happened here at the BRICs summit.
Great to be with you, Shane. Great to be with everyone. Lots to get through today. And obviously, I really want to tackle, spend a bit of time in a minute, looking at there's been so much mixed information about the BRICS summit, and there's definitely been some pushbacks, which is understandable. I mean, we're talking about the US hegemons being really sides blasted here. And so we'll look at that. And I'm going to cover what we have actually discerned ourselves from our very well-connected Sino-Russian facing BRICS bloc contacts, as opposed to what we're getting third party, alongside directly related to expectations for gold and silver price performance into the end of the fourth quarter, and so far we've been going quarter by quarter, and they've all been jiving. But to answer the immediate shorter-term questions, let's get those out of the way. I want to start by taking a look at the very short-term expectations following first notice for the November's futures contract today, which is Wednesday the 30th, and forcing, and we'll explain that in a minute, but forcing, this is the very last day for those, do you remember we talked about the ability to be able to drag your feet into delivering contracts is when they should be delivered at the beginning of the month. For example, we're talking about October. They should have delivered those on the 1st of October, and there's been some people dragging them out in gold and silver too. And so we're going to take a look at at those. Basically, this is the last day for those foot-dragging agent banks to deliver or pay a big price to exit the remaining October contracts, and then to get ready to start the process of delivering November contracts. And as you will see in a moment, the silver data really captures some of the naked short specs we covered in our last episode that we expected would get margin called on their options bets against silver, and we now see these gaslighted fools being carried out feet first. We got evidence of it. We captured the moment it happened. And also, when this episode is released on Friday, the non-farm payrolls data will have been published. And given it's the last report before the US elections, I would be amazed if it was not a rigged to be another politically sought beat, headline beat. And of course, the prior so-called beat from the prior report, of course, it'll be adjusted lower. But of course, the algos look at the headline. So for this section, let's pop in to look at the charts.
So starting with gold, now bear in mind, the ability to deliver these October contracts could have been discharged on the 1st of October. And that's all the way back here. So as we drew attention to, in fact, if you remember, this is where we recorded our last episode, and the previous episode on the 2nd. This is the episode we recorded on the 16th. And of course, now we're recording between the AM and the PM fix on Wednesday, the 30th. So as we drew attention to that the last time, by incurring friction to store and delay delivering these October contracts points to an attempt to try and rig lower prices so as to cash settle these delivery obligations inside the casino environment. Well, as we're going to see, these efforts seriously failed. Now, with the window closing to deliver or square up the last remaining 25 October contracts, and we're tracking these right now. I'm just going to give you this. So this is the spot price. This is the spot premium over this October contract. So you can see right now it's varied. Actually, it's been as high as 60 odd dollars. It's currently $43. Now, bearing in mind, there's still 25 contracts to square. So, but over the last 3 weeks, we've evidenced some 2,500 October lots being squared at an average spot gold premium of $10. Now, obviously, now it's really expanding because there's a couple of days. Really, this is the last delivery day. And obviously, these premiums are required to comply with NSFR compliant spot FX gold, which conservatively cost them at least $2.5 million to exit these liabilities, meaning they could have cash settled the casino chips. And that only represents 4%. Obviously, they only hold 4% of the value of these real physical delivery gold positions. And what it illustrates is they're consistently undervalued against the regulated deliverable physical markets. That is, until they're called for delivery, that is. So given the physical market are increasingly being priced and settled outside the fractionally held CME LBMA ring fence, as we identified last episode, this 3-week paper to physical disconnect was telegraphing that any and all dips would be shallow into the extremely tight for physical supply. Now, obviously, we're capturing this live. This is $40 odd October premium to exit these delivery obligations, really, and that is after gold broke out to all-time highs today, as we can see here in this December contract. Now, compounding the cartel's synthetic mispricing, they now face having to deliver against the 758 November lots. That's some 212 million coming due for full funding into first notice today, as we record this episode on Wednesday the 30th. Now, as a reminder, first notice is when 4% held casino chips that only cost about $11,150 to control, a single 100-ounce lot of COMEX gold will have to be fully funded at a cost of $278,700 per contract. That happens today. So clearly the specs get out of these contracts and it leaves it sitting in the hands of the professionals. Now, while the November contract is not considered to be a delivery month and mostly relates to derivative structures, it precedes the much larger December delivery contract, which we're tracking here, expiring at the end of this month of November. Now, which happens to be, well, I say this month, when you get this on Friday, it'll be November. And this happens to be the largest delivery month of the year. And it's the only month of the year that the silver contract expires alongside gold. Now, as we assessed in our last episode, a lot of bets for or against gold and silver are placed in the most liquid December contract, and they look out 12 months in advance. So really, the prior contracts would have been placed around here. So you can see when you've bet against a price, and we see the result of that pricing now as we approach the end of the December contract, or the December contract expires at the end of November. What's of interest this month is the easier to read silver speculator bets that had for the last 10 years been gaslighted into accepting the cartel's carefully rigged ranges. You remember we went through that in detail in our last episode. And what they'd done is, if you remember, we had identified they'd bet against silver and were about to receive an unwanted religious experience as silver broke out into the September 2012 highs. We'd identified this was their capitulation point, and it got blown through. If you missed the last episode explaining just how these specs had been set up, please review it, as this episode captures the cartel was planning to call in margins, which is the loans they had granted to the specs to bet against silver. And this did indeed ring the register on this very profitable ruse. So in summary, with the physical flows increasingly bypassing loco London and being physically settled outside the cartel's reach, and that the market-making bullion banks are without exception all long silver for their own books, they have begun to let silver start to run. Now, this brings us to some captured evidence. Now, the window to square up the last remaining 10 October silver futures lots closes today. On average, the 1,440 lots, when I say quote unquote delivered during October, has on average evidence a spot premium of about 28 cents per ounce to cash settled. These lots ought to deliver at that premium. And at best estimate that has cost the cartel foot-dragging holders a mind-boggling $2 million to exit these massively leveraged bets against silver. And now they have to face up to the 582 November lots coming due to be fully funded into first notice at the pit close tonight. Now, this next slide captures the exact point that the last option specs got wheeled out feet first into the pit close on Friday the 18th, just as spot silver approached $34. And a total of 29 October lots were margin called at a $2, over $2 backwardation to spot. I mean, that is huge. And that single margin call cost these spec bears a $295,000 premium to exit these bets against silver. Now, with the last spec bets rinsed out, it temporarily puts the power back in the hands of the cartel, with their sweet spot closer to $33, but underpinned at that level by BRICs facing safe haven and industrial silver demand. Now, once this is squared, this coiling effect will force the next leg of a physically driven rally. Now, non-farm payrolls, which you will receive as this episode gets published, may offer some stackers an opportunity to grab more silver into any algorithm gaming. And you can see this gaming here is cartel-induced. The specs are gone, and they were rinsed out all the way back here. And the only specs on board are actually using silver as a safe haven hedge. Or could be Indian and Chinese buyers looking to take delivery of the futures contracts. So this kind of gaming, we just mentioned that the sweet spot is closer to 33. Well, that would suit them very nicely into first notice today, which when they have to fully fund all these contracts. So just explaining it as it is, and this is the 10-day moving average. So clearly what we're seeing here is some testing of the stops, or the long stops and the short stops. This is not unusual behavior. And right now, as we head into first notice, we see silver flip-flopping between a 60-cent and a 20-cent premium to spot, or rather spot at a premium to the October contract. What we're illustrating here is the cracks in the CME LBMA cartel being aggressively exploited by the global physical markets, bypassing the tendrils of local London cartel and settling silver at prices a real seller is willing to part with the bullion. Silver is about to discover a real supply-demand balance. And given the massive deficits, silver deficits, that price actually should be closer to $200.
Hey, Andrew, just before we started recording today, we were discussing your take on the BRICs Kazan summit, which brings into view a great deal of what has so far not been reported on the mainstream media or anywhere. I think that we have to report what you have to report right here. What you were talking about will push back against the spun narrative, which attempts to play down the de-dollarization process here. What's your take here?
Yeah, the first thing to report is really it goes against the planted negative mainstream media narrative, trying to ignore the historic Kazan summit success. And Pepe Escobar puts it well, and I think he says it was historic in more ways than one can imagine, and that Kazan really should be seen as, I think he puts it, as the departing station of a high-speed train journey towards emerging multi-nodal new order. I mean, that was his. I read that I think a couple of days ago, and it was excellently put. But he's the only one that actually really gets it. And following last week's summit conclusion, the mainstream media headlines suggested that progress towards the single currency BRICs settlement, that was the unit we were talking about, it appeared now, it wasn't on the front burner, it was still in development. However, as we have evidenced here in this Bloomberg report, which I'm linking here, what it does do is draw attention to the previously identified split between the Bank of International Settlements and the United States. And you remember we covered this at the time. When we saw that split, it was in November 2022, when the BIS covered all their 500 odd tons of derivative bets against gold, went long, and the Fed still continued to this day to fight the price of gold. So that was a split. And what it did is reveal this once again reared its head. The naked short of gold US hegemons put pressure on the long gold Bank of International Settlements to push back against the Bank of International Settlements non-dollar denominated settlement platform, which had been well telegraphed. And they were presenting the argument, that by allowing the launch, it would enable heavily sanctioned countries to circumvent the US dollar's unilaterally imposed sanctions, I may add, and potentially undermine the dollar's dominance in the global financial system. Yeah, really. And following the BIS splitting from the Fed by revaluing gold as a first-year asset class on the 1st of January 2023, and as we remember, against all the Fed's protests, it exposed the Fed as the only central bank still betting against gold. Now, the pressure to rein in the Bank of International Settlements Enbridge solution that we spent a lot of time looking at has opened up the next leg of the war between the Bank of International Settlements and the Fed. And the Bank of International Settlements is much more embracing a multipolar world They get it. And whereas the Fed is still desperately hanging on to this unipolar hegemon view. Now, while the Fed pushback against Enbridge is being spun as a negative, as we will explain, with or without Enbridge, which would ultimately have really cast the net out beyond the currently sanctioned countries, the buy stealth gold revaluation event that we've been evidencing has been driven by every single global central bank diversifying out of dollars to buy as much gold as possible in order to bolster the value of their individual foreign exchange offerings, their currencies, which are now increasingly measured by the percentage of gold that backs these individual currencies. Now, Enbridge was going to provide an easy platform for that, but it's no surprise the much heralded Enbridge central bank digital currency has caught the attention of the deeply wrong-footed Fed plunge protection team, who they love the idea of a central bank digital currency, but not a gold-backed one. And these 40% gold-backed offerings expose the Fed's naked short rehypothecated gold positioning, hence the efforts to dissuade non-core BRICs members from widely adopting it. Now, the timing of this BIS sanctioned rollout put the Fed really between a rock and a hard place. Thus, threats of direct, indirect geopolitical interference. And while non-core members are biding their time until the US elections are settled, and that's only next week. So beyond the financial appeal of the bloc, many countries are seeking to adopt the BRICS membership really as a form of geopolitical insurance and are most definitely on board to find ways of hedging their dollar bets with gold. And as we highlighted in our episodes, all the episodes since February, it is as pivotal an event as when Nixon removed the ability to exchange dollars for gold. And this process has been unfolding by stealth. We've looked at it on the charts month by month by month. Now the train has left the station. What cannot be hidden is that the ultimate ease of adoption for existing bloc members, alongside a multiple of fresh applicants being able to join this bloc to access the sufficiently liquid, de-weaponized, and it was originally the Enbridge payment solution, but there are others, it fully exposes the pivotal inflection point where, against the Fed's lobbying efforts, the BIS revalued gold, as I say, as a first-year asset class in 2023, triggering the largest on and off-record global central bank institutional physical gold accumulation drive in history. The bulk of these gold purchases involved divesting dollars for US treasuries. In fact, just like in January 2023, we don't see the gold bullish BIS laying down for the short of gold Fed. They're likely choosing their timing until after the election. And we can report through our well-connected BRICs facing contacts who have been correct into every single twist and turn that to facilitate trade between already sanctioned nations, Russia has activated both Glaznev's Option 1, BRICS STR-like basket of currencies, as well as rolling out the big guns, which is the extremely liquid gold and commodity grain and natural asset-based currency, which will be officially named and launched shortly after the US election next week. Now, through distributed ledger technology, other words, on the blockchain rails, already sanctioned nations have everything to gain and nothing to lose into participating. And to give an idea of scale, a full 1/3 of all countries are already sanctioned, including 60% of the low-income nations who either produce or consume the lion's share of all commodities, and they will be pricing these commodities, including gold, silver, and precious metals, rare earths, etc., traded amongst themselves, priced in gold. So the attempt to block this Enbridge platform so as to maintain waning dollar dominance will fail, because the lion's share of global commodities are going to be priced as benchmarked against gold. And these same global facing assets, when they're priced in depreciating unbacked dollars, will be massively inflationary in dollar terms. We've covered this before, but I'm going to expand on why the current by stealth gold revaluation process will continue to unfold. Now, our BRICs facing liquidity providers continue to expect a minimum of 3,000 gold just as the first staging point for Glasnev's option 2, which our contacts confirm is most definitely going to be rolled out now. And ultimately, this sanction busting solution is designed to confluence with a revamped Enbridge unit-like solution in some other form. But, the BIS is not going to roll over here. Also, if Trump wins the election, we may see the dollar selectively de-weaponized, which could actually see many sanctions, including those against Russia, evaporate. So we don't know that. But the chances are, once there's peace or some form of peace settlement agreed, why would the sanctions need to exist? Notwithstanding the headlines, the Central Bank of the UAE and the People's Bank of China, they've already formalized currency swap agreements. They've utilized Enbridge. They've also utilized other platforms. So in early September, I think the UAE was on record executing an international China digital yuan exchange for the UAE's central bank digital dirham. And they used Enbridge at the time. There's other facilities here. And while the Fed is pushing against wider adoption of Enbridge, pushing against it, they will attempt to roll out their own dollar-denominated central bank digital currency. And while some bloc members may utilize such a platform, it won't solve the risks of any future dollar weaponizations. For example, if China encounters large tariffs, it probably moves against Taiwan. Probably a much less to lose by doing so if it's already sanctioned. Also, a potential Trump presidency forewarning of sanctions, tariffs being imposed on any country pursuing a de-dollarizing mandate, explains some interesting BRICS maneuvering by Russia and China, stick-handling the BRICS alternative settlement platform to be immune from Western sanctions. Now, into this mix are well-connected liquidity providers integrated with the current sanctioned core members, confirmed that Glasnev's beta-tested option 2 is planned to be formally announced directly after the US election. So we're almost certain this is going to roll out. Likely on the 1st of December, it would be just enough time to liaise with Trump and his intentions. If Harris wins, liquidity providers indicate it will be announced on November the 6th. Now, in the interim, every single central bank, sovereign and institutional investor is hedging their dollar assets with physical gold. And while the CTAs, the commodity trading advisors, a lot of them we've called the useful fools in the past, but a lot of them are using gold as a sticky hedging item. They may from time to time cash in their risk market hedges into stock market margin calls. Usually that's when we've seen the discounts, is when they've literally dumped those hedges when stocks have fallen. So every single ounce, though, every ounce, kilo, ton of gold that has flowed through the BRICS nations will never return to the West. And whether this gold is utilized by a single member to benchmark their foreign exchange currencies, as it would relate to the LBMA dollar fixed price, i.e. how many rupees, etc., it would require to take delivery of a globally priced physical bar for immediate delivery, that is, or perhaps to provide non-dollar denominated gold-backed swap lines so as to participate in Glasnev's yet to be named option 2 gold-backed platform.
Now, Andrew, as you once again correctly predicted, it looks like that Glazev's gold-backed commodity currency is actually ready to be named and launched. And you also mentioned some other interesting information. Can you sum that up, please, what you were mentioning?
Yeah. And to sum that up, all under the radar of the Kazan summit headlines, some major gold drivers are now in play. And as we anticipated, Putin and Xi are boxing clever ahead of an increasingly likely Trump presidency, as was trial ballooned by Putin's so-called olive branch comments 2 days ahead of the BRICs Kazan summit. And with Trump looking increasingly likely to win, Putin offered Trump an opportunity to back off US sanctions and move to reverse some of the last administration's dollar weaponization efforts, outlining, as he put it, the risks of rushing into the BRICS single currency plan. Now, Putin was essentially offering an opportunity for central banks to begin cooperating. Ever pragmatic. People don't understand this guy is pragmatic, but his statement was actually conjoined with a mandate for the BRICS bank's capital to be significantly increased. So from a financial perspective, offering the deep state hegemon, albeit a very unlikely to be accepted olive branch, presents a leveling strategy not too dissimilar to, say, one nuclear power agreeing out of necessity to peacefully respect the other out of mutual strength. And in this case, the financial nuclear strength is that the BRICS nations have already armed themselves with sufficient zero counterparty risk physical gold to directly compete against US hegemons' high counterparty risk US treasuries. And given the state of the US finances, this is a powerful negotiating position to be in. So let's see how this rolls out. And furthermore, the spun narratives that we've been seeing continue to be blinkered to the already broken dollar bond gold correlations. And they failed to factor in that, stick handled by the Sino-Russian alliance, the gold price is now being physically priced and settled outside the tendrils of the US dollar hegemons, who comparatively hold a very, very weak gold hand.
Now, one only has to look at the massive rally that commenced directly after the PBOC weaponized gold by stealth on the 1st of March, strategically opening up the Shanghai Futures Exchange to act as the conduit to target and drain the COMEX price setting mechanism. Now, the over $700 rally from the missile launch has exposed gold as well as well on the road to being revalued by the BRICS nations. Every single global central bank except the Fed is on board. And if you remember, we identified, we'd circled this blue circle here, and last time we'd also circled it here, identifying this as a similar catalyst. And if we step back and look at the big picture on a very stripped down chart, this is the exact point that the Bank of International Settlements railed against the Fed and revalued gold as a first-tier asset class. And look what's happened since then. The divergence between the BIS, and which is very much multipolar facing, and the unipolar US dollar, US Fed, is clear. Just before I end the charts here, look at the November premium in silver. And this is the spot premium to November. So even that is now really backwardated.
So what's being misread by analysts who are trying to spin the BRICS summit as a dud, basically? And that while the US hegemons are threatening bloc members to rein in attempts to de-dollarize, the already sanctioned nations are by necessity aggressively de-dollarizing. Now, the BRICS Cross-Border Payment Initiative, that's the BPI as the acronym for him, it's being actively bolstered, and is geared up to enable both sanctioned and non-sanctioned nations to use national currencies without interference when they trade with each other. And each of the foreshadowed BRICS blocks ultimately produce or consume around 85% of all commodities. So a large percentage of these trades will be settled amongst themselves without incurring US hegemons pushback.
You know, Andrew, as you've been drawing attention to the dollar weaponization risks that are very real here, so given an alternative non-dollar settlement, let's say it's an alternative, why would a trading bloc risk using the dollar unless it really had to?
Yeah, exactly. Precisely, Shane. Dollar weaponization has to date evidenced the seizure of hundreds of billions of dollars of assets that have been stolen, have actually just been taken with a click of a mouse, alongside the freezing of the reserves of Iran, Syria, Libya, Afghanistan, Venezuela, North Korea. I mean, these are all nations that have had their reserves frozen. As yet, not stolen, but frozen. And as a result, trade between these mega trading hubs are having to be settled using a mixture of their own nation's currencies as they are valued against each other, requiring a sufficiently liquid gold benchmark to enable a sufficiently liquid sanction-proof trade. And there's certainly enough gold. We've looked in previous episodes at just how much gold backs the Sino-Russian alliance on its own. Now, Pepe Escobar correctly points out, too, how the monopoly that the United States exercises over the IMF ensures global demand for dollars, which is why it can run these massive current account deficits while weaponizing its currency at the same time to serve its geopolitical interests. Now, the growing number of BRICS nations see the US government as waging economic war around the world, i.e., against the multipolar world. And alongside literally seizing hundreds and hundreds of billions of dollars of assets from their adversaries, they've imposed unilateral sanctions, click like that, on a third, as we say, of all countries, including 60% of low-income nations, which is deliberately designed to cause them problems. And to provide contrast, just the original 5 BRICS countries make up 32% of global GDP. But inequitably, they've only got 13.5% of voting shares of the IMF, whereas the G7 nations only make up 30% of global GDP, but hold over 41% of all the voting shares of the IMF. It's a rigged game. So, given every single one of these sanctioned nations have as a direct result of dollar weaponization, they've been strategically accruing or settling transactions in gold. And the settlement process is far simpler than the naysayers indicate. You don't need Enbridge. And as we were trying to illustrate earlier, because globally settled FX gold fixes are reclassified as a first-tier asset class, competing with US Treasuries, the global gold fixed price provides a real benchmark to actually value all currencies and derivatives thereof. And that includes the 60% of those nations, smaller nations. Now, this provides a benchmark to value how much of a nation's foreign exchange currency would it take to actually buy a gram, a kilo, as I say, a ton, but for immediate physical delivery. Therefore, the higher the percentage of gold that nation is able to demonstrate they put up to the BRICS as a bailee, as security for a transaction, or to simply back that currency swap or trade, that explains. So really, it values it, which explains why all of these nations' central banks have for years been aggressively accruing gold. So setting Enbridge completely aside, because so much has been made of the fact that it's been delayed, the value of each foreign exchange cross, as I say, really is determined. It's so good, so clear. It's got to be so clear on how this is valued now, is how many actual rubles, reals, rupees, etc., would be accepted as a payment in full by a seller of physical gold facing the global market. Meaning, the higher the percentage of gold that nation is able to put up as a security, prices that transaction. And obviously, the decentralized 40% gold-backed Enbridge CBDC platform had already been tested and will almost certainly be back in play, simplifying the process of settling these BRICs transactions, and probably limited it won't be as apolitical, perhaps in its early days, as was originally intended. Now, with the BIS ultimately acting as Bailey, the unit settlement process securely benchmarks how much gold backs up and benchmarks the value of each of these respective nations' foreign exchange cross. Now, as we drew attention to at the commencement of 2023 trading, Glasniev's gold-backed CBDC platform had also been beta tested and will perform exactly the same function as Enbridge, but it will be designed to face sanction-proof the 1/3 of nations and the 60% of low-income nations who are already sanctioned but accruing gold. Trump's proposed, it could be 100%. I've heard it 1,000 to 2,000% in some of his speeches, talking about these tariffs. So his tariff platform, as yet unknown, but a minimum of 100%, is primarily targeting China. Obviously, that Europe is mixed in there, the UK is mixed in there, but possibly also reaching into all countries doing business with China. Given that the full gambit of BRICS nations have boarded the Kazan train already, and they either produce or consume ultimately 85% of all commodities, and trust in the weaponized dollar is already long lost. Ultimately, the multipolar BRICS alliance has little to lose in de-dollarizing into a ramped-up inflationary environment. In fact, liquidity providers really assess that the tariffs would actually drive even more inflows into gold and will continue to aggregate the liquidity assessments of $3,000 gold just as the staging point. And this is the minimum assessment, with several liquidity providers estimating $8,000 gold in 2025. Bottom line, under the noses of the synthetic actors, gold is being revalued by stealth in all global currencies. It's not so much an event as a process. And much like these past few weeks, pulled efforts to try and contain gold, it's clear that any short-term officially tricked in synthetic market profit taking will continue to be jumped on by a tight for supply physical market. So under the attack narrative, it has to be borne in mind that BRICS is not an anti-Western group. It's just a non-Western group. But can you blame them for sanction-proofing themselves? And just a couple of other notes here. The Shanghai-based New Development Bank, the NDB, will be headed by ex-IMF Russia's Alexei Mosin. Now, the NDB is the main investor in technological and infrastructure projects for BRICS nations. Now, this includes the sanction-proof Northern Sea Route, which the Chinese define as the Arctic Silk Road, which Putin revealed will actually, at the conference, he revealed it will utilize 7 nuclear icebreakers, 34 diesel-propelled heavy-duty icebreakers, alongside international north-south transportation corridors, with the BRICS triad Russia, the triad Russia, Iran, India, all key partners. Of course, they're not doing this because they're not expecting sanctions. Of course they are. They're expecting it one way or the other. So while the US hegemons try to play down the de-dollarization effect, it's patently clear that the already sanctioned nations have nothing to lose, everything to gain in adopting the proposed BRICs initiatives, and that by stealth, the gold price revaluation process will continue. In fact, as I say, $3,000 gold is just the staging point for Glasniev's yet to be named gold settlement platform, with a growing consensus upcoming tariffs will see gold valued closer to $8,000 per ounce. Now, look, really, I'm just trying to bring to you what we are seeing through our contacts, not through through what we're seeing published elsewhere. It leaves us just one question, though, guys. And the only question that remains is, how much physical gold and silver do you own right now?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical and make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled out there. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. And please help keep spreading the word about this channel by hitting that like button. If you haven't already done so, hit that like button right now. Share this information so more people can find out about the community and the channel. And now, if you're subscribed and you click that bell right there, we'll notify you as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.